Hannah, Becky, I'm having my kitchen done at the moment. So we went out at the weekend to just have a look at stuff and ended up buying a oven and a hob for a ridiculous amount of money. So my question is, what's your best impulse purchase that you've made?
I was at a craft fair once and I saw a lovely stand with a lot of crocheted items on, and a particular cactus with a Mexican hat on caught my eye, and I thought, yeah, that'll look good, and I bought it for a shocking amount of money. Yeah, now it sits awkwardly in my lounge on the shelf.
Why, hello, I'm David Udall, here with another episode of Agronomics, helping farmers and those in the food supply chain understand their finances a little bit better. Hold up, listen, I'm going to stick my neck out here and say if this podcast didn't exist, you could be left thinking it was the best thing I never had. It's the middle of AHDB's market outlook season. So in this episode, we're going to do some future gazing in both the dairy and the beef and lamb sectors. So what do our forecasts say? Is it deja vu or are things set to change? Keep listening and you'll find out. And along the way, you may hear some song titles. Take note, as they'll lead you to this week's mystery musical act, Farming and Music, the perfect duet. Please follow and subscribe to this podcast to make sure you don't miss an episode. New shows drop Wednesdays at midday. And please get in touch. Comment on any of AHDB's social channels or email us agronomics@ahdb.org.uk. So what have we released at AHDB recently? We have been talking about pork cost of production. We released our quarter 4 for 2024 estimates, which is putting the full economic cost of production at 197 pence per kilo deadweight. So that is cost of production which is increased by 7 pence from quarter 3 in 2024. So we've gone from 190 pence a kilo to 197. Feed costs have been a bit of a driver in this because feed costs have risen through that quarter. And as we've spoken about before, the importance of cereal markets in pork cost of production, the feed cost now takes up about 63% of total cost of production, which is an increase of around 8 pence from when we previously looked at it in quarter 3. So increased in cost of production for pork because of that increase in feed costs. So it will be interesting to look out for when we have our cereals outlook, which we're going to be talking about in a couple of weeks, and what that longer term vision for the cereal supply is and how it will impact pork cost of production. And another interesting thing that we've released is looking at the consumer angle and what consumers are looking for when they're choosing their recipes. And here's some interesting stats for you. In the research that we did, talking about priorities when you're choosing a recipe or a meal with or without children. So when you're just choosing a recipe without children, so just choosing just for yourself, maybe just having a nice little lunch, taste is a priority for 60%. Whereas when you have children in the mix, it goes down to 49%. So we don't really care if the kids like the taste of it. But nutritional value is definitely important for kids. It goes up from 28% seeing it as a priority to 36% when children are involved, and the same for quality from 40 to 45%, as I guess you'd expect. But the taste one's interesting. Maybe we should be asking kids what they feel like from their food. If it was my son, it's probably going to be a Cadbury's cream egg, so maybe not the most nutritious. I don't know if we can do product placement. So if you're listening, Cadbury's, I'd be more than happy to have some free cream eggs come my way. Got to be unbiased as AHDB. Any cream eggs, to be honest. Any brand, I'll take them. First up on our odyssey going through our market outlooks, we're going to focus on the dairy market and milk. And we're joined by our lead analyst for dairy, Susie Stannard. So welcome, Susie. So let's kick off talking about, milk production and what our outlook is saying for where we expect that to go for 2025.
Well, I think anybody who's been paying attention will not have failed to realise that milk has been absolutely flying for the last few months, really since since autumn last year. We sort of ended that period of things being a bit weak, which was really in a bit of response to that awful wet weather that we had last winter, sort of from last autumn going all the way through. That really had a long-lasting impact in terms of damaging the ground, holding back grass growth, and that combined with low milk prices really sort of held back production. What we've seen in the last few months, though, is a sort of turnabout phase. The milk prices have gone higher. So we've seen a really, really strong milk to feed price ratio. And that gives us a bit of a clue that when that milk to feed price ratio is high and above 1.2, then we can expect to see growth coming through in the system. And that has been definitely true for the last 2 or 3 months. We've sort of been between 2 and 4% growth year on year per month, which is pretty stonking. So the question is how long will that go on for? And looking ahead through 2025, we're going to expect to see growth carrying on, certainly through the spring flush, probably a bit beyond that as prices still remain high. And then we'll probably start to see some softening off in the autumn as we're annualising against that higher autumn that we saw last year. So overall, we're expecting to see milk supplies increasing moderately in the region of 1.1%, which is good growth kind of coming through the system.
I guess, we've said it loads of different times on this podcast, but it's kind of the beauty of agricultural markets and commodity markets is they are very rational. And as you said, there's been a massive incentive for milk production driven by high commodity prices for fats, etc. And then feed prices have been relatively lower and therefore incentivizing it. And yeah, that input cost side of things is definitely improved, hasn't it, in recent times?
I think that's massively played a role. We've had to really try and balance 2 sets of factors. And one set of factors was actually quite negative, really. And there's some of your more structural factors. So we've seen a lot of farmers, even leaving the industry because, concerns about things like inheritance tax and ongoing tax burdens and higher interest rates, limiting, access to easy credit. There's a lot more environmental regulations and other things, which are all kind of acting to put a bit of a brake on production. And that was sort of the underlying story. But it's interesting, isn't it, that when feed prices drop low enough and the milk price goes high enough that it's actually worth pushing, and farmers have just gone, OK, let's make hay while the sun shines and let's push on. And that's just really, really sent production going skywards, which, as you say, is a very rational way to behave. The problem that we have is that when there's a lot of milk in the system, then that is also a signal back the other way to the processors to start to turn the taps off a bit, because particularly as we head through the spring flush, and we typically would get a bit of oversupply at that time of year, that's when we're going to need to kind of put a bit of a cap on it, and that's lower prices is the mechanic by which we usually do that.
Yeah, we're definitely back in that classic kind of commodity production cycle, aren't we? That we've got the period where we've had a tighter market. It was incentivized to produce more. Everyone rationally pumps more milk out. So all of a sudden there's more in the system, people back away. And we'll be talking about it in a couple of weeks when we talk about the cereals outlook. But we've come from a very, I suppose, benign period in cereals market, in animal feed markets as well. There hasn't really been any significant shocks, but that will also start to potentially ramp up through the spring, because that's when we always see those, cereal production risks because of the spring weather and challenges to both, either it's planting in the US or conditions in Europe or Russia, wherever it may be. So it does feel as if we've been through a very, I suppose, comfortable phase for dairy, and we're potentially going through what could be a bit more of a trickier phase. But on the positive side, there's some positive sides on the demand side of things, isn't there?
Yes, no, definitely. But just going back just quickly to the supply side of things, just on that. Yes, we are expecting prices to kind of contract and things like that, but there are a number of risks which we could see. So disease risk in particular. So we've seen blue tongue virus starting to hit our shores and making their way halfway across the country in the autumn before the cold weather came and put a brake on things. We will be looking now to see what midges have overwintered and what they bring in the spring. But the risk is that if midges have overwintered and they get a good head start, they could start causing some problems, because we know for dairy cows, it's not like with sheep where it's, completely devastating, you tend to lose them. What does happen is it causes quite a big drop in milk production. And we've already seen that in markets like the Netherlands and in markets like Germany, where their production, they've been badly affected by blue tongue virus and their production's gone negative. So that is a possibility for the UK. So even though we've been a lot ahead, if we get a bad outbreak of BTV before we've had chance to vaccinate, that could sort of change some of that factor. So that's just one big risk that we need to bear in mind, I think, when we're thinking about this. The other side of things, so going back to what you were asking me about originally, was about the demand side of things, wasn't it? Demand's been pretty steady, actually. It varies depending on which commodity that you're looking at. And it sort of echoes this ongoing trend that we've seen over the years. So consumers generally drinking less milk these days. So there's less milk consumed as a big, pint of milk. Fewer hot drinks, for example. People are more likely to have something like a herbal tea that doesn't need milk in it, or a bit of a return to the office as well. So people are drinking less cups of tea at home. So that's meant that we've seen a bit of a decline in milk. We've also seen a bit of a decline in butter. As you know, you alluded to it earlier, butter has seen absolutely record-breaking prices in wholesale, and that's been filtering through to the retail picture. So for consumers who are doing better these days, and we've seen in our economic outlook, they're not feeling quite as pinched as they were previously, but they're still not feeling completely rolling in it. So for those kind of cost-sensitive consumers, they have been more likely to substitute more expensive butter for cheaper margarine. So again, rational behaviours that happen in response to economic challenges. So there we're seeing a bit of decline. Where we're seeing some good growth is in cheese. Cheese consumption still flying, which is great. And the other side of things, there's a great pun there, by the way. And the other side of things that's been doing really well is yoghurt, actually. So yoghurt has been growing a lot. And we think that's to do with consumers starting to look towards healthier eating again and looking for products with health benefits. So we're seeing a lot of things like yoghurt with high protein claims, with gut health claims, prebiotics, probiotics, things like kefir, doing really, really well at the moment with consumers, which is great because it opens up dairy to different markets. So as well as an indulgent treat, it can also be a healthy option.
I think milk is pretty irreplaceable in my household, considering the volume that my 4-year-old packs away. I think I still stand that I could invest in my own dairy unit in my back garden, and I'd be comfortable, potentially make a profit out of it as well, actually. That's kind of insider trading, I suppose, isn't it? I don't know if we're allowed to do that or not. I'd have to find out. Right, Susie, thank you for that. Thank you for going through everything. That was, I think, as we can say, from a dairy perspective, it's been a very good period, hasn't it? It's a very positive period, but there's definitely some, I don't want to say like clouds on the horizon in terms of definitely kind of, risks and negatives, but there are some things that could put, 2025 is a bit more of a challenging year than what we've seen in the last sort of 6-9 months or so. Mm-hmm. So I suppose keep an eye on all of the analysis and information that you and your team are putting out, because that's going to be the thing that's going to sort of fully explain the market direction as we head through this period.
Yeah, absolutely. And you know, dairy farmers, they're a resilient bunch. This is not their first rodeo. They're very used to the ebbs and flows of the dairy market and milk prices. But we just know that those farms that will do the best are those ones who are most in touch with all of their business basics and on top of their numbers and everything. And then people who are really looking at the numbers and the market. So yeah, use our stuff. It's there to be used. Please do.
Exactly. We don't want this to be a game of Texas Hold'em, do we? This isn't a game of gambling. This is about making the best decisions with the information we have available. But Susie, thank you for your time. We're going to have a break now. We're going to get the latest from the markets, and when we come back, we're going to be talking about the beef and lamb sectors, and I'm sure that blue tongue will get a mention then as well.
Hi, I'm Helen Plant, Senior Analyst at AHDB, with a look at grain and oilseed markets for the week commencing the 3rd of February. In recent weeks, wheat prices have drifted sideways, while rapeseed prices have retreated. Crop worries, which focused on low temperatures for US winter wheat crops and continued dry weather for maize and soybean crops in Argentina, have been offset by worries about global demand for grains and oilseeds. In particular, markets had been waiting to see if the new US president would change trade policy as promised during his election campaign. The president announced higher tariffs on imports from Canada, Mexico and China over the weekend and suggested more tariffs could follow for the EU and others. This pressured prices. However, with talks already underway, markets remain uncertain. And US trade policy, along with weather conditions in North and South America, is likely to remain a key factor for grain and oilseed markets in the weeks to come. To stay up to date with the latest data and analysis across arable, red meat and dairy markets, head to ahdb.org.uk and click on Markets and Prices.
Pork.
British pork. Pork is sticky, pork is spicy, pork is air-fried, slow-cooked, baked. Pork is high in protein, low on cost. Pork is sauce around your chops. Pork is not just Sundays. Pork is midweek, every week. This is British pork, but not as you know it. Pork is...
So welcome back to Agronomics. As we mentioned before that break, we're now going to be talking about the beef and lamb sectors and our outlook. So joining me are Hannah Clark and Becky Smith, and we're going to start with the beef side of things, with the cows. Hannah, we're going to talk about cows. What's going on with the outlook for beef markets and cattle markets going forwards?
This year's supply is going to play a massive part in the market. We've seen very strong production in 2024, despite the fact that we were looking at lower inventories of cattle across the country. Slaughter last year was a fair bit higher than we were expecting based on the number of cattle we were seeing on the ground and in the data from BCMS. Coming into 2025, we're still seeing reductions in the number of young stock coming through the system. So we've seen in previous years reductions in the number of particularly suckler-born calves coming through. We have seen an increase in the amount of dairy beef calves being born, but in recent years, those reductions on the suckler side have outweighed this. And so what we're seeing now is a tightness in supply coming through the market, and that has certainly been reflected in prices and where they've moved, certainly in the first few weeks of 2025. I mean, our average prime prices have sort of gone up about 15 pence each week for the last couple of weeks. So demand for available cattle is very strong at the moment, and in terms of our outlook for 2025, we're forecasting a 6% reduction in UK prime cattle slaughter for this year versus last. Those supply dynamics are really going to play a key part in the market this time. Balanced against that, we're expecting a slight growth in domestic consumption. So our forecast for beef consumption in the UK is growth of around 1%. And what that means is we're expecting an increase in the import requirement for beef this year as those supply and demand dynamics sort of play out.
My question, Hannah, really is around price. As you say, we've had a very bonkers period. I mean, we thought we were seeing kind of, a steady uptick through the market since mid-June last year. So, I mean, the low point of the deadweight market I'm talking about here, the low point of the deadweight market of deadweight steers last year was about 478 pence a kilo in the middle of June, which isn't really low in historical context of long-term cattle prices. That's still a good price, as it were. We finished the year then at 554, and then since then we have seen that huge increase, literally through January. We started, the 4th of January when we reported a price at 556 pence a kilo, and we've now broken through that £6 a kilo mark. There's always that question of will it continue, and I don't think any market can continue on that kind of upward trajectory because of the gain that we see and that price increase. And I mean, we're seeing that in retail and supermarket shelves now in terms of the the retail price of beef going up. So you would expect that there could be some tempering of demand at these prices. And again, this is what we talk about with agricultural markets. They are very rational, supply and demand based. As the price goes up, people will move away from the product because it's too expensive. And that is the great leveler and balancer in markets. I mean, I don't really see how that market can continue at that pace, because essentially markets just start to damage themselves when they start moving at that pace. But ultimately, from a fundamental perspective, the overall fundamental picture hasn't really changed and won't immediately change because of the nature of how the cattle market works. So a few months ago we were talking about £5 a kilo being the new kind of base level for the market. It could very well be that actually for the short term, that trading around that £6 a kilo mark is going to be where we stand, which is obviously positive from a farmer selling perspective because values have moved up, but it doesn't feel as if it's going to be around there forever. Those longer term shifts in market will happen. So we may still be trading at historically high levels, but I don't think a market can inflate itself in this way and continue on that same trend exponentially through the year. So I guess it's a price risk. And one of those price risks, I guess, but it's something that can even tighten the market further, then comes back to blue tongue. And we spoke about that with Susie in the start and the impact on dairy supplies. And this is something that we'll have to be very conscious of as we go through the spring and the increase in midges and the vector of midges. Again, one of my favourite words, vector. And how that will impact the in the cattle market. That's going to be the big open-ended question, I think, isn't it, as we go through the next 3 months to May time.
The risk of that blue tongue threat is definitely there. I mean, for the sake of our forecasts, we haven't factored in any impact of that, but it certainly remains a key area for us to keep an eye on in terms of what that means for restrictions and people being able to market their animals. You talked about fundamentals as well and where that price might go on the beef side. The supply it's not there at the moment in terms of cattle numbers, and that, given the time it takes to breed, rear, finish an animal, it's upwards of 2 years. So those supply side factors I can see continuing to offer support to the market generally, because it will take some time to turn that ship of production. And I guess it's a key question for us at the moment is at what point does that beef price actually start to incentivise production and start to, I guess, outweigh those other financial pressures around, cost of inputs and reductions in basic payment and all those other factors. At what point does that beef price start to, make people change their mind and start to retain more heifers and expand their herds and therefore grow production? But even if that does happen now, it will take a few years for that to feed through into production levels that we see.
And this then takes us back to the conversation we've had recently around not only the impact of inheritance tax, but kind of, I suppose, like you said, the wider financial pressures that in that environment, when there's financial insecurity or uncertainty, probably a better way of putting it from an agricultural perspective, we know that detracts from investment. So there isn't even, there's a price incentive for farmers to invest and, as you say, to retain heifers, grow herd size, etc. But there's also now an incumbent risk within that in terms of the potential marginal gains that would produce, whether that would then increase their asset value, which then puts them potentially into an area where they may have to pay tax upon that. So there is an existential risk within it, which ultimately, I suppose from an AHDB perspective, the reason why we are commenting on it and wanting to kind of get into the depth of it is that does then create market failure, because we talk about agricultural markets being rational beings and they react to supply and demand, but we're putting this in a picture now where, because of external forces, whilst the fundamental supply and demand is essentially saying produce more, it's either saying produce more to increase supply or cut demand. We've got demand destruction, as we'd call it from an economist perspective, when the prices increase. One of those things needs to happen. But obviously from a supply side perspective, there are now greater risks from a farming angle in terms of the, like you say, the wider financial business risks in the longer term, which may potentially prevent some farmers from deciding to make those investments, because actually the longer term gain is being eroded because of all of these other pressures, even though the price is still there. And as we see from an agricultural perspective, and again, we spoke about this with Susie from a dairy perspective, in the way those commodity cycles happen, the farmers are planning on today, but there is no guarantee that market will still be at £6 a kilo in 2-3 years' time when that herd expansion is starting to kick in. And so actually financially, they may get a double whammy, that not only are they increasing their herd size, potentially making their business less efficient, because obviously you get into marginal gain theory, not to get too geeky economist about it, and obviously you kind of have a bell curve of that, and if you start going over the other side of that bell curve of efficiency, you start losing money. Basically, farmers can't keep on producing more. There's a point where they actually end up producing more and make less money out of it, so they could be making themselves more inefficient. They could then be not necessarily gaining on the price, because by that point the fundamentals have changed and the price has dropped, so they've increased supply, but then they can't recoup on that value. And then there's the external pressures of potential inheritance tax and others which further come forward. So it isn't as simple as just saying make more beef. There isn't just a beef tap that we turn on. That'd be a weird thing, but there isn't one. So it's just the beef market is intrinsically interesting because of that. It feels as if it's kind of on that precipice. And that's why we're here as AHDB, to do these outlooks, to have those bigger picture conversations, so we kind of have an open discussion about it and everyone's got the information to make those decisions. Right, beef rant over. Becky, let's now rant about sheep. Before we talk about blue tongue and things like that with sheep, let's just talk about the outlook, and let's just talk about the headlines that we've got from a sheep perspective at the moment.
The headline figure is we're looking at total sheep meat production to grow by about 2% year on year. So that's throughout 2025. The big driver on that really is the carryover. So those 2024 lambs that we've seen kind of really struggle. We struggled through lambing, we struggled through the autumn. Those kind of falling over into 2025 and hiring that kill in the first half of the year. Other headlines, we're looking at a slightly smaller lamb crop again, mostly driven by reductions in the breeding flock. And on the demand side, we're looking at a slight easing in demand, but obviously following an absolutely bumper year in 2024. So still seeing that kind of retail and food service demand higher historically, but just back slightly on the highs of 24.
We look at prices from where we've been. So let's talk about 24 prices that I suppose in a similar vein, but a different trajectory. We are starting to see a move lower in the deadweight SQQ for lambs at the moment, aren't we, over the last 2 or 3 weeks? But we're still starting at a position which is higher than where we were a year ago, when we saw those lamb prices really get pushed up because of those strong retail demand side of things, the demand from religious festivals through Easter, Eid, Kobani, etc. Are we seeing that same level of retail promotion at the moment? And do we think there'll be a similar level of demand? It doesn't feel as if it's out there.
Yeah, so I think maybe you spoke about Christmas a few weeks ago, but we saw over Christmas a much lower proportion of lamb on promotion of Christmas of 2024 versus the year before, where we saw those kind of $6.50 a kilo joints in retail really, really highly discounted. And I think that's part of our outlook for 25, is that actually there will be probably less promotion, particularly on those roasting cuts and those kind of bigger cuts, which will, build into that reduced demand picture. I think the price outlook is obviously a slightly trickier one. I think if we build in potentially that slightly lighter demand from retail, and then if we see a little bit more supply come forward, I think we really saw supply underpin those crazy sky high prices in 2024, with the expectation of a little bit more supply in 25 and a slight easing in retailer promotion. We might see the price slightly more level, I think, slightly less reactive maybe than we saw in 24. Obviously, we can caveat that with it's hard to predict what demand will do throughout 24. Consumer demand was much higher than we expected. And on the supply side, we're obviously, as you mentioned earlier, quite susceptible to risks. So things like the disease risks of blue tongue, Schmallenberg, and on the lamb side specifically, those weather risks have such huge impact on our supply. So kind of all of those caveats on where we might end up.
No, I'd agree. I mean, that there is that supply risk going forwards, because we've spoken about it from a dairy perspective with blue tongue in terms of making dairy cows less efficient. It's the same from a cattle perspective, slows weight gain, etc. But we're at the other end of the spectrum from a sheep perspective with blue tongue, because it just unfortunately kills them, which isn't the best place to be if you're a sheep. Not to be too lighthearted about the horrible disease. That's I suppose the thing which is the overall risk, because we did have that double whammy last sort of winter into spring, where we had disease pressure in the early lambing flock from Schmallenberg coupled with strong demand. It was already a sort of a tight supply base, so that was the reason why those both prices got pushed up. You can still see that there would be an instance as we go through the year whereby supplies get tightened if there is a significant outbreak of blue tongue. And thankfully last year it didn't spread too far west into where you'd see the historical bulk of the lamb flock. So it's going to be hugely dependent on wind and weather, as we say in there. Two things. While we try to give an outlook on the majority of things, I'm not Michael Fish. I can't forecast the weather. So that's going to be the key thing, isn't it, from a lamb perspective? Realistically, it's just going to be the impact of those disease and then that weather pressure to see what happens as we go through. So we will obviously be reporting on any changes in that as it happens, but it will still be an interesting market to watch. Hannah, Becky, thank you. You may have noticed the sheer professionalism of Hannah and Becky through that period as they managed to keep a straight face and answer all of those fantastic questions. Should I say fantastic questions? That's bigging myself up a bit there, isn't it? When I was trying to big you up, that's a bit of the wrong way around. Fantastically answered the questions whilst my 4-year-old son was actively trying to distract them in the background. So thank you, boy, for that. Also, we've thrown a few song titles in, and the mystery act of this week was Beyonce. Beyonce Knowles. I'm going to say it out loud. Right. I think I prefer Destiny's Child to Beyonce.
That is a bold statement.
Yeah.
She's just won Best Album.
Yeah, I know.
The
But
Grammys.
You think it's better than the Grammys?
Yeah. Well,
Isn't she Beyonce Carter as well?
oh, obviously, yes, of course. Yes, sorry. Don't want to annoy Jay-Z, do we? Ooh,
So
no.
much
Sorry, mate.
slander.
Yeah. I'm saying that like he's down the road from me. You know, don't want to annoy the neighbour. He's not at all. Don't think he lives in Leicester. Anyway, thank you both. We're going to be talking about the environment and how it links to retailers and farm insurance next week, which will be interesting. And then we've got cereals and pork outlooks coming up after that. But that's it for another week of agronomics.